Okay, you guys will now start exercise 2-9. Again, we're looking at some adjusting journal entries, which of course would be made at the end of the company's fiscal year to update the accounts in the ledger so that the balances are correct for our financial statements. They say prepare, let's read through it first. Prepare the necessary adjusting entries at December 31st, 2016 for the microchip company for each of the following situations. Assume that no financial statements were prepared during the year and no adjusting entries were recorded. Okay, let's start with number 1. On October 1st, 2016, Microchip lent $90,000 to another company. A note was signed with principal and 8% interest to be paid on September 30th, 2017. Okay, here on our last problem exercise we looked at, the company was a borrower. Here they're going to be the lender. Okay, so what we want to do is figure out how much interest Microchip Company has earned on this note from the date it was drawn on October 1st, 2016 through their year end December 31st, 2016. So that's going to be 3 months of interest. Okay, so we're going to calculate interest earned on note receivable for months of October through December 2016. Remember, in calculating interest, it's always the principal or face amount times the period of time covered by the note times the interest rate. So that interest rate is always stated in annual terms. So here we're calculating how much interest they've earned. Well, the note was dated October 1st. Our financial statement date or fiscal year end is December 31st. So we're dealing with 3 months out of 12 months. So this will give us the percentage of the year covered, which of course is 25% or 0.25. Okay, the face amount of the note was $90,000 at 8% interest, so we'll say $90,000 times 0.08 for 8% times 0.25 for the period of time covered by the note. That gives us interest of $1,800. Okay, so we'll come back to our journal, and this is number 1. Okay, we're going to debit interest receivable, which is an asset account. Companies earn this interest even though they're not going to be paid it until next year. It's an asset for them at year end because they earned it in fiscal year 2016. And that was what, $1,800, right? Double check. Yes. Okay, now remember, we record revenues when they're earned. Well, we earned this $1,800 of interest in the months of October through December 2016. Even though we're not going to be paid until next year, we'll go ahead and record the revenue in the year in which it was earned. Revenues increase on the credit side. Our asset interest receivable increased on the debit side. Okay, let's move along to number 2. On November 1st, 2016, the company paid its landlord $6,000, representing rent for the months of November through January. Prepaid rent was debited. Well, if we're paying more than 1 month, if as a tenant we're paying more than 1 month's rent at a time, we would set up the asset account prepaid rent. So the account they debited was correct. We'll assume they credited cash, of course, on November 1st. But on November 1st, they had they prepaid rent for November, December, and January, 3 months worth, right? So they had an asset prepaid rent of $6,000, representing 3 months' rent on November 1st. But by December 31st, 2 months of that have expired and become rent expense. So our rent expense account has increased. Expenses increase on the debit side by the amount of rent, by the amount of prepaid rent that's expired from November 1st to December 31st. Well, what that's going to end up being is our $6,000 divided by the 3 months to get the amount of rent per month, times 2 months to get the amount of rent that's expired by December 31st. So the $6,000 divided by 3 months paid times the 2 months that have expired. And that gets us $4,000. And that's going to be credit. That's a debit to rent expense, our expense account that increased. It's going to be a credit to rent revenue. Excuse me, not rent revenue. What am I saying? It's going to be a credit to the asset account prepaid rent. Our asset account decreased. If that confused you, then you're on the right track probably. Our asset account prepaid rent decreased by $4,000 because the months of November and December have passed off. So that prepaid rent, our asset decreased by $4,000, rent of $2,000 per month, and rent expense has increased by $4,000, our rent of $2,000 a month that has expired. It's no longer prepaid. So that's going to leave the balance in prepaid rent. It's going to drop it from $6,000 to $4,000. It's going to drop it by $4,000 from $6,000 down to $2,000, and that $2,000 represents our 1 month that's still prepaid, January. Let me go back through that one. We want to debit rent expense for the amount of rent expired from November 1st to December 31st. Well, what we did here, we said it's $6,000 total, and we paid as a tenant 3 months. So we divide the $6,000 by 3 months to get the amount of rent per month. Now, how many months of rent have been used up or expired? Well, November and December, so we multiply by 2. That gets us our $4,000. That's an increase to rent expense and a decrease to prepaid rent. Rent expense is an expense account, increases on the debit side. Prepaid rent is an asset account, decreases on the credit side. All right, number 3. On August 1st, 2016, we collected $12,000 in advance rent from another company that's renting a portion of Microchip's factory. The $12,000 represents 1 year's rent, and the entire amount was credited to rent revenue. Well, that part's incorrect. We should not have credited rent revenue. Instead, unearned rent, or the book, your book calls it deferred rent revenue, should have been credited. So let's look at this one. This entry was made on August 1st. So let me show you. On August 1, here's the entry that was made. The debited cash, the asset that increased, $12,000. That part was correct. But instead of crediting the liability account deferred rent revenue, and it creates a liability for us even though we received cash because we haven't earned that yet, right? We can't call it rent revenue until it's been earned. They paid the $12,000 in advance. So it creates a liability for us. We either have to let them occupy that space in our factory or return their cash to them. So we're taking on an obligation by accepting their cash. They should have credited deferred rent revenue, but instead they just credited rent revenue. They treated it as if it had already been earned. We know that's not the case, though. So this is the entry that was made. Okay, now let's look at the August 1st entry that should have been made. Okay, cash would have still been the debit. But the account to credit should have been our liability account. Deferred rent revenue. Now, like we did in the earlier problem, I think we should go to T accounts for this. This is our entry that should have been made. Now, neither one of these is the answer to number 3. I just think looking at these two, the entry that they made and the entry that they should have made, makes completing the third instruction a little bit easier. Now again, let's go to T accounts to see what we want to do with this one. Okay, you guys, so to help with this one, number 3, I set us up some T accounts. Here's what the August 1st balance of both accounts should have been. Well, that's not correct. It's not what they were. Excuse me, that's what they were. That's what the August 1st balances were for each account. Deferred rent revenue should have been $12,000. It wasn't credited though. Its balance is 0. Rent revenue was credited in error. It's got a $12,000 credit balance on August 1st. Now we want to get it to the correct balance on December 31st. Let's figure out what that correct balance should be. For rent revenue, it should be equal to the number of months of rent earned from the day the payment was received on August 1st to the end of the year at December 31st. So let's figure out. It's going to be equal to $12,000 total rent received divided by the number of months that they paid. They paid for 12 months times the number of months that we've earned, that the company has earned from August 1st to December 31st. So that'd be August, September, October, November, December. 5 months. Okay, so the balance in rent revenue on December 31st should be $5,000. Rent was $1,000 a month, 12,000 divided by 12, times the 5 months earned from August 1st through December 31st. So August, September, October, November, and December. Okay, so the balance in rent revenue on December 31st should be $5,000. So what should the balance in deferred rent revenue be? That's our liability account. Well, that's going to be the amount that's left unearned. To me, the easiest way to do that, you take the total amount received, $12,000, and subtract the amount that's been earned already, the $5,000. So the balance in deferred rent revenue on December 31st should be $7,000 credit balance. The balance in rent revenue, the credit balance on December 31st should be $5,000. So how do we do that? Well, in rent revenue, we've got a debit balance of $12,000, or excuse me, a credit balance of $12,000. We want to go to a credit balance of $5,000. So if we debit the account for $7,000, that's going to leave us with this $5,000 balance. So let's look at how it works out. Credit balance of $12,000, a debit adjusting entry of $7,000, so we'd subtract, leaving us with a credit balance of $5,000. All right, so this is our adjusting journal entry. All right, the account to credit. Well, we want to go from a zero balance in deferred rent revenue to a balance of $7,000 on the credit side. So we need to credit that account for $7,000 as well. So I hope this makes sense, you guys. Deferred rent revenue on August 1st had a zero balance. This balance should have been $12,000, right? But that's not what happened. We credited the wrong account, rent revenue. So on August 1st, deferred rent revenue had a zero balance, and rent revenue had a $12,000 balance. Both of those were incorrect. We know, though, at December 31st, the balance in rent revenue should be $5,000, equal to the amount of rent we've earned from August 1st to December 31st. To get that, we take the total amount of rent received, $12,000, divided by the number of months the tenant paid, 12 months. That gets us $1,000 per month. And then we'll multiply by the number of months from August 1st to December 31st, which is 5 months. So our balance in rent revenue on December 31st should be $5,000. Well, the part left unearned that we'll earn in the next year, 2017, should just be equal to $12,000, the total received, minus $5,000, the amount we earned in 2016, leaves us with a balance of $7,000. So to do that, we'll end up our adjusting entry will be a debit to rent revenue for $7,000 to bring its balance from a credit of $12,000 down to a credit of $5,000. And it'll be a credit to deferred rent revenue, our liability account, to bring its balance from 0 up to $7,000. So we want to debit rent revenue on number 3 for $7,000. And we want to credit deferred rent revenue for $7,000. What this does is correct this error. We made this entry on August 1st. We should have made this entry. This entry corrects this, and it brings both accounts to the correct amount at December 31st. Okay, we'll start back with number 4 in the next video.